Hello and welcome. This is Bennett Tchaikovsky, and welcome to Financial Statement Ratios, Part 3, Profitability and Valuation Ratios. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email prior to doing so at bennett1812@gmail.com to talk. And note the author does not claim any copyright whatsoever in any of the companies or organizations mentioned in this presentation, collectively the other parties. Rather, the other parties are the owner of their respective copyrights. Before I start, I want to give a huge thank you to Investopedia. One of my former students at IVC used Investopedia and really spent time on it, and that helped her land an internship with an investment banking firm up in LA. So it's a great website. It's been absolutely invaluable in terms of creating this presentation. And since I'm using a lot of the definitions from Investopedia, I'm giving them a huge shout out and a thank you. So our part 3 of our ratios is really looking at profitability. And when we look at profitability, there's a couple different ones that we can look at. The first one are kind of what we would call the profit margin ratios. And what these really are doing is they're taking certain elements of the income statement and showing it as a percentage of total sales or total revenue. Generally, for every $1 of sale, how much are we going to be ending up with net profit? That's what we call the net profit margin. Pre-tax margin, company's profitability after accounting for their non-operating expenses, operating margin, gross margin. Gross margin for a retailer is very important just because really what this is doing is this is telling them for every item of inventory that they're selling, what is their profit, basically, what is their profitability on on an average per unit basis. The next one here is on a return on assets. Return on assets is an indicator of how profitable a company is relative to its total assets. We're going to take net income divided by total assets to get return on assets. Note here, I've also seen this as being net income divided by average total assets. I would probably say if it makes a huge difference, meaning if total assets have shifted, you may want to look at using average total assets, but if the numbers are the same, you could just use total assets. And then lastly, we have return on equity. And this is also sometimes referred to as return on net assets. What this is this is going to be net income divided by average shareholders' equity. The next one we're going to look at is earnings per share, or what this is a portion of a company's profit allocated to each share of common stock. Earnings per share is the net income minus preferred dividends, all divided by the weighted average common shares. And when we're looking at profitability ratios, this is again is really how are we doing profit-wise as a business in terms of looking at financial statement net income. I mean, that's really a lot of the greater focus of these right here. The last one we're going to look at is what we call a valuation ratio. And what this is we're going to be looking at the market price per common share, and we're going to divide that by earnings per share. And this is an interesting one because this is kind of telling us is how many years of earnings will it take a company to earn back its stock price. And there's some other valuation ratios out there, which are price to sales, price to cash flow, price to earnings growth. Again, there are limitless analytical tools we can go out and use there. We're only covering a few of these here in this lecture. This is really geared towards generally lower division financial accounting students and also lower division managerial accounting students. I do hope, though, that some in the upper division courses can gain from these presentations. Okay, so what we're going to do here is I'm going to pause real quick and we're going to go to our actual examples. So I'll be right back. And hello, we're back again. So we're going to go ahead and we're going to do some of the profit margins. And the first one I want to look at is net profit margin. So for the Home Depot, this would be their net income after income taxes divided by the total sales. Where am I getting these numbers from? Well, if I go to the Home Depot and I look at their annual report, here are their net sales of $100 billion, and their net earnings or their net profit is going to be $8.6 billion. Notice sometimes in the equations, net earnings, net profit, same thing. Net sales revenue, same thing. All companies use different language for calling things what it might be, but again, at the end of the day, they kind of still have those same definitions. So right here, my net earnings for Home Depot was $8.6 billion, and my total sales was $100 billion. So my net profit margin, meaning that for every dollar of sales, how much net income am I generating? It's about 8.5%. And then let's look here at the gross margin. Here we're taking the gross profit of $34.35 billion and dividing it by total sales and getting it to be about 34.05%. If you've seen my income statement covering common size financial statements, you'll hear a much more in-depth discussion on this part. Let's go over here to Lowe's. So here for Lowe's, their net margin or their net profit margin is going to be their net earnings, or $3.4 billion, divided by their net sales of $68.6 billion. So we go over here, 3.4 divided by 68.6. For their gross margin, it is going to be, their gross margin was $23.4 billion, and we're dividing that over here, or their gross profit, we're dividing that by the total sales, gross profit divided by the total sales, or 34.1%. Now notice for the profit margin, really Home Depot and Lowe's are coming in. Lowe's is slightly higher, but again, they're in the same industry. I would refer you back to the presentation on the common size financial statements for a further discussion of these two companies. Now, lastly, Facebook is a little bit more interesting because Facebook doesn't really have cost of goods sold. They have what we call cost of revenue. So the ratio to kind of better look at in terms of Facebook, as far as instead of calling it a gross profit margin, we might want to look at it as in terms of an operating profit margin, or the income from operations of $20.2 billion divided by $40.6 billion. And so right here, we're end up getting about 49.7%. And at the same time, Facebook does really, really well in terms of its net profit margin. Right here, after its net income was roughly about 15.9 million or 15.92 million. So you have this right here, this, I think I used 15.93. I did it before the participation. So roughly it's here, it is about 39%, which is significantly higher than Home Depot and also Lowe's. But again, Facebook is a social media company. They are not a retailer. So very different types of businesses. But again, I'm putting Facebook in here just to kind of show the overall comparability. The next one we're going to look at is return on total assets. And for Home Depot, I'm just going to use total assets for Home Depot and Lowe's because this was pretty close to one another. So right here for Home Depot, in terms of the return on total assets, I'm taking the net earnings of $8.6 billion and I'm dividing that by the total assets of $44.5 billion to get about 19.38%. So they're doing pretty well in terms of, how much, for their what kind of income is being generated as a result of the total assets they're holding. Here for Lowe's, Lowe's has total assets of 35.291 billion. And that's being divided over here, that you're taking the net income of 3.4 billion, and we're getting 9.77%. So we look at Lowe's, and from a a return on assets perspective, Home Depot seems to be double that of Lowe's. And lastly, we have over here Facebook. We have that same net income, 15.934 billion, but I'm going to make a change right here, because when I was mentioning earlier about average total assets, the total assets here for both Lowe's and for Home Depot are, they're relatively the same. I mean, it went from 34.4 to 35.2. And here for Home Depot, it went from 42.9 to 44.5. But for Facebook, it went from 64.9 to 84.5 billion. So I want to probably use the average here. And if I use the average total assets, let me see if I can find this from my friends that I did earlier. Perfect. Okay, my average total assets here for Facebook are roughly, it's about 21%. So again, is that a good number? Have no idea. I would need to go through and look at other companies that are in similar places. The next one we're going to be looking at is return on equity. Now, this is where we get into a really interesting discussion for Home Depot. So our net income here hasn't changed, but the average shareholders' equity for Home Depot was about 2.8 billion. How did I get 2.8 billion? I took the beginning shareholders' equity as of January 29, 2017, which becomes the beginning on January 30th, 2017. Took the ending, which is 1.45 billion, divided that by 2. And so my return on equity is almost at 3. And to remind ourselves and to kind of go back, well, why is that the case? Home Depot is a very interesting company. They have reacquired this was as of January 28th of last year, about 48.1 billion worth of their shares. And that number is even higher today. So Home Depot is pretty aggressive in terms of using its extra cash to continue to buy back their own shares. So that's why that number looks really, really high, and it's probably going to be an outlier for any other company that we'd be looking at. If we look at the return on equity here for Lowe's, we have 3.4 billion, and we're dividing that by average shareholders' equity of 6.1 billion. And over here, so how did I get that shareholders' equity? It's the 6.4 plus the 5.8 divided by 2. And so I'm getting here 6,154 million. So that number here in terms of return on equity is 0.56. And for Facebook, their average shareholders' equity was 74 billion and then 59.1 billion. So their return on equity was about 0.23. Obviously, for these numbers, you want this particular one to be the higher, the better. So here's Facebook. Their equity went from 59 billion to 74 billion, mainly as a result of an increased overall retained earnings. And so that's what we have over here. So the next number we're going to look at, that's return on equity. The next one here is earnings per share. This is also a number we want to be as high as possible. Notice though, some companies, they are going to be negative in this arena. Why are they going to be negative in this arena? Because if you have a startup company or a company that's incurring a lot of losses, you may have no earnings per share. It may be zero, it may be a negative number. So the way we're going to compute earnings per share is we're going to take the net income minus the preferred dividends, and we're going to divide that by the weighted average shares outstanding. So here for Home Depot, their net income, and I put this in absolute dollars, this was 8.6 billion. I put this into the actual number because when we are coming up with this dollar amount, we want to use this right here because Well, we kind of want to see, it's like, okay, I've got 8.6 billion, dividing this by the actual number of shares outstanding to get my earnings per share. So let's see how this works. So I know that my net income or my net earnings for Home Depot is about 8.6 billion. What it tells me is my basic weighted average common shares outstanding was 1.17 billion. Now, before we go any further, the weighted average share calculations for basic are relatively easy to do, because you're just seeing what if the shares were actually outstanding during the full period. Here for the Home Depot, they had 1.7 billion shares at January 28th, 1.7 billion shares at January 29th. But you might be asking, well, wait a second, if this is 1.78, then why is this 1.178? It's because Home Depot has been going through and repurchasing shares. Just in that one particular year, they bought about 40 million shares back. So when you look at that weighted average shares outstanding, that gets taken into consideration. So here, the basic weighted average common shares are about 1.17 billion, giving us our basic earnings per share right here of $7.33. So this is kind of how that number is being generated right here. The next one I'm going to go to is Lowe's. And Lowe's we said they had net income of about 3.4 billion. And in terms of weighted average shares outstanding, I had to do a little bit more digging, because on their income statement, I think, where did that go? So right over here, I see, basic earnings per common share is $4.09. Okay, well, where are my weighted average shares outstanding? Well, to go figure this out, I had to go through these financial statements and essentially dig up in the footnotes. The footnotes are our friends, and as we go through here, we can find much more detail in terms of, looking at as far as, what are some of the additional details that are not being included in terms of our financial statements. And if I come down here, I did find it earlier. This is probably the part where I should go through and pause, which I'll do right now. Awesome. I literally just found it right when I said that. Okay. So it says right here that my net earnings applicable to common shares, 3.4 billion. Weighted average common shares outstanding, 839 million. So right here, my weighted average, or my earnings per share, is roughly $4.11. And this is for the year ended. Let's make that correction. This is going to be here for the year ended. Wow, good job, Tchaikovsky. Why aren't you pausing this video again? My eyes are going crazy. Okay, so this is as of February 2nd, 2018. Get that right. February 2/2. Oh. Okay. So right over here, this is how we came up with the earnings per share. One of the things you'll see is what is diluted earnings per share. Basic earnings per share are the actual number of shares that are actually outstanding by the company. If the company is making a profit, then we also need to include any share equivalents. That would include warrants, stock options, anything that's kind of like any kind of convertible bonds. Those are different items that we would have to go through and include as far as doing a fully diluted earnings per share calculation. However, if the company's at a loss, then we only compute basic. So right here, got $4.11. And then lastly, we have Facebook, which for its stock over here. Now what Facebook is, what is interesting is Facebook has two different classes of stock. If I take the total amount of the income, and this is 15.9 billion, which comes from right over here, 15.9 billion divided by the total number of shares outstanding, or the weighted average shares outstanding, this is what I end up getting in terms of the earnings per share on a basic and then on a diluted basis. So when I come over here, though, in terms of looking at this as a ratio, one of the things is that when I went online and kind of said, well, wait, what is the difference between Class A and Class B? When Facebook went public, Mark Zuckerberg did not want to lose control of his company. And so he gave the general public stock that had 1 vote per share, but the Class B shares that he holds are at 10 votes per share, which are really held by Zuckerberg and then some other insiders. So that way Zuckerberg and his other insiders can really maintain control of the corporation. And you might be asking me, is like, whoa, how did you get these two different numbers right here on their items? I'm only seeing this 15.934. Well, I'm going to pause just a moment and then I'll wake up and show you. And we're back. And right here, you can see the allocation here. This again is in the footnotes. This is under note 2 or under earnings per share. You had net income of 13.03 billion. Class B shares were 2.9 billion. And so that's really what's getting us to the total amount of net income, or that 15.934 billion. So usually what we can do is we can go into the footnotes to find additional information. So the last one we're going to focus on here today in terms of the valuation ratios is that I want to have you look at what is price to earnings ratio? What exactly is this? Well, what this can be an indicator of is, from an accounting standpoint, how over or underpriced is a particular share of stock. So for here, for Home Depot, if I take Home Depot's current stock price, and this is $179.58 as of January 18th, 2019. So when you are watching this video 5 years from now, you're going to be laughing at me. And we look at here, and I take this amount and I get a price to earnings ratio of roughly 24.5. What does this mean? It's going to take Home Depot about 24.5 years to earn back their share price. However, why is it showing here on the market summary that this is 19.59? Well, what is more than likely happening here is this might be something we call trailing 12 months. What does trailing 12 months mean? Trailing 12 months means is that they're taking the more recent data. Remember, what I'm showing you here is last year's financial. They have another 3 months more, so more than likely their earnings per share over the last 12 months have been higher. And that's what's driving this, basically this price to earnings ratio down right here. So again, the price to earnings ratio is kind of saying, well, if I made $7.33, how many years will it take me to earn back my current market price? In this case, it's about 24.5. If I did it for Lowe's, Lowe's had as a current stock price as of January 18th, 2019 of $94.98. And so here for Lowe's, it has a P/E to ratio of 21.11. We're relatively close on that, or it's about 23.11. And, we were at 23.11 again. We're using older financial data. The same with Facebook. Facebook's current stock price right here is $150.04. And right there, its earnings per share is $5.49, which we computed up here. So the price per share in terms of for Facebook is about $27. The earnings per share is about 27.31. So, and again, if this is correct, the price earnings ratio is 24.36. Now, just so we know that these tables may not always be exact. And case in point is that one of my favorite companies to show when it comes to the price to earnings ratio is Amazon. And I'm going to pause just a really quick second here while I go through and pull up their information. Right here, current stock price as of January 18th, 2019 is $1,696.20. Their earnings per share is $17.84. I'm going to be right back and show you where that is on the SEC filings. Hi, we're back. So right over here, if I look at Amazon, if I just use this $14.49 in terms of their earnings per share, and the actual number I think that they're using is $17.84. Remember, this here is for the 9 months ended, and there was another website I found which is like, okay, the actual number is around 17. So if we use that 17, and I assume a current stock price of 1,696, the price to earnings ratio for Amazon is about 95. Well, if I look here at the Google market summary, I see a price to earnings ratio of 372. If I just read this, it would be saying that it would take me 372 years to earn back a share of Amazon. But right here, we're coming up with about 95. So what does that mean? It means you should not believe everything you see on the internet, unlike what I said before. So if we look here, and they're coming up with a price to earnings ratio of 104.38. And is this correct? Probably our number is relatively close to it, so I might say yes. But it's just to kind of remind yourself that you see a number on a website, don't automatically assume it's correct. Go through and at least make sure that you're in the ballpark, because if you're turning in something, which if I use 372, like it says on this, and it's actually only about, if it's about 95 or 100 and something, that's not going to be good for anybody. So you want to make sure you go through and do these ratios. So again, I want to thank you for joining me here today. These are just ways we can measure a company's profitability. Remember that these are using accounting numbers. Accounting, the way we do accounting, there are inherent limitations in how we go through and record transactions. And ratios are a part of a way we can help better understand and get comfortable with a company. It's kind of like doing, you could call it Moneyball for companies or financial statement analysis. Whatever you want to call it, you need to make sure you're doing this prior to lending anybody any money, prior to doing business with other people, and the like. So that concludes our presentation on the profitability ratios. And I'll just go back to this other thank you. Again, please do not forget to like, share, and subscribe. If you have any feedback, please go ahead and send it to me. And thank you for joining me today on another ratio journey. Thank you.